welcome everybody. Welcome to this seminar with Vincent Mok, who is sitting there. You can see him on the screen. He's in nice warm Malaysia, and I, waving now, am in wet and windy North Wales, where Bangor's based. Just while we let a few people still in, I was reminded of the importance of having an officer, a risk officer, and we'll see in a moment that Vincent is the group risk officer for GXS Bank. And you may recall almost exactly 3 years ago, Silicon Valley, which we hear a lot about because it's to do with microchips and things, but we heard about Silicon Valley Bank that collapsed spectacularly. And I've posted something into the chat area. You can have a look at it now or later, where the headline from the Wall Street Journal says it's the most thankless job in banking, and Silicon Valley Bank didn't fill it for months. And they operated for a year or more without a chief risk officer, and therefore it's amazing they survived that long, really, to be honest. So yeah, don't be Silicon Valley Bank or anything like them. On the screen now, you can see a picture of Vincent, and he's been involved in senior capacities in risk analysis management for over 25 years in international and regional situations. We'll talk about some of these as we get a little further in to the seminar. Currently, he's the group risk officer, chief risk officer at a Singapore digital bank regulated by the Monetary Authority of Singapore, backed by two very large companies. Grab is a similar to Uber. Grab has expanded, but it started out with call-up cabs and things and what have you. And Singtel is the formerly known as Singapore Telecom, which was a government monopoly and is now a listed company and things. And that's interesting when we talk about risk and the response of organizations and individuals to risk. Well, the response of Silicon Valley as an organization was not to have a chief risk officer. But we'll be talking with Vincent about appetite for risk in different kinds, appetite for risk for different kind of products. And we might speculate that when an organization changes from being a monopoly, government-owned, to operating in the commercial sector, as Singapore Telecoms did, Singtel, how do they make sure that they adjust their perspective on risk? So let's just have a look at a couple of slides which are setting the scene. If you don't know much about risk management, this won't take very long. I'll just briefly cover some of the things, and then we'll get into talking with Vincent. It's amazing how things change so quickly. January 2026, what's that, 2 months ago, the World Economic Forum published its Global Risk Report. And if you can see the picture, there's a picture of the world, the globe, on the edge of a canyon. So it's balancing on the edge of a precipice. And the reason I chose this is just to show how things change in the World Economic Forum publication. You've got the link there should you wish to have a look at it afterwards. They have a section that says, what's been the biggest increase in ranking for various factors in the short term, 2-year period when they published it in January 2026? Well, geoeconomic confrontation, up 8 places. Well, I think, yeah, we've had that. Economic downturn as a result of geoeconomic confrontation, rise in inflation, disruption to critical infrastructure. So the survey that the World Economic Forum carried out was people's perceptions of what might become risks, and these were indeed they. Moving on to the next slide, please. So, risk management and the 28th of February, which was when the US and Iran came to blows. Each of those individual risks on the previous slide would be bad enough on their own, but of course they're not isolated. They're all linked together, and there's a knock-on effect to create a perfect storm, defined as a particularly violent storm from a rare combination of adverse factors. Would we call it a black swan event? Extremely rare, unpredictable occurrence with a massive impact, often rationalized after the effect as having been predictable. Well, here are just a few of the examples of impact that I've logged in the last few days, and it affects all stakeholders. It's the Bank of England could be forced to raise interest rates, which will affect mortgages for people's property purchases. The food trade body in the UK is making a plea for energy. Price of energy goes up dramatically, the cost of growing certain foods and also transporting them. An individual company selling furniture is already in a short term suffering. Its shares are unclear which way they should go. They've collapsed at the moment because it's expected if we're spending more money on heating our homes in the UK, price of food's going to go up. We won't have enough perhaps to spend on discretionary purchases like furniture. So fewer people are going to the shopping mall to look at furniture. The United Arab Emirates has seen a lot of its expatriate population fleeing because of the war, and they're saying, well, maybe we as a government have to change our regulations. We've given very lenient and attractive propositions to attract expats with regard to tax, but it does require a certain number of days residence within the UAE. Maybe we'll have to change that. And kind of ironically, although Donald Trump himself is a great believer in oil based carbon heavy energy, there's a growth in the clean energy sector. I saw in the Financial Times this morning that China's companies, 3 of them, have gained $70 billion in market capitalization because it's expected the batteries that they make will be in demand for clean energy, something which Trump is against. And airlines, so it affects you and I as individuals, companies, governments, industry sectors. Airlines suffered a huge blow. It'll, I'm sure, increase in size because the cost of fuel will rise, or aviation fuel has already risen. There'll be shortages of aviation fuel, and already some of them are talking about cutting routes for travel. It'll certainly have an impact, I suspect, on where people go for their holidays. So it's very quick that we have these impacts, and we can't be sure where they'll end up. The next slide, please. It shows there's a very quick look at what's risk management. Well, every one of us, individuals, organizations, we face various kinds of uncertainty, and risk management, whether we practice it formally or perhaps informally, is a way of trying to navigate this uncertainty. The process is set out as often carried out by many organizations. It's from the Association for Project Management. It talks about we identify some of the problems, we assess them, we plan a response, we implement it, and then we monitor it afterwards. And one of the things we'll be talking about is the need for communication with those stakeholders involved. The slide that comes next talks about the types of business risk, and all of these have got the web pages if you want to go and see them. And there are different kinds of risk that we require different strategies to mitigate: operational, financial, strategic, reputational. One of the interesting things about the reputational risk is the Financial Times in the last couple of days has talked about the risk for Qatar. Now, the Gulf state Qatar has had its infrastructure for gas, etc., bombed, but the article was talking about Qatar has been seen as a place to go for it's safe, it offers business opportunities, and the country as a whole may suffer from reputational risk where people will be concerned about, is it safe to go there? So a wide variety, not least of which includes technology at the bottom. And one of the things that Vincent's been involved in is setting the first digital bank in Malaysia. We'll hear more about that, and the risk of systems failure. Next slide, please. So the next slide talks about the steps in risk management. I've emphasized in bold, if you can see it, some of the behavioral aspects. Risk management, it can use artificial intelligence these days, of course, but also for analyzing data, it can use information technology, but often there's a human element in it. The big challenges are, can we identify the risk in time, and can we work out what the balance is between risk and control? How do we ensure that it gains acceptance and in its implementation across the whole organization, buy-in? So there's a human dimension to it. And how do we intend to handle risk may be slightly different from how risk actually is implemented. What's our appetite, our tolerance for risk? Who's responsible for coming up with this? Well, clearly in Silicon Valley Bank, it wasn't the chief risk officer. They didn't have one. And how do we communicate the strategy and the plan we've developed, so that the idea being we can be agile and we can be resilient? Well, the next slide is here it comes. This one. KPMG in 2025 listed a number of particular risks for banking. Top of the list, geopolitical fragmentation. Well, that's a theme that we saw with the World Economic Forum, etc. Something that we've touched upon and Vincent will talk about is digital operations and digitalization and meeting regulations in various jurisdictions that we work in. The need to have quality data as we do this analysis of which are the most important risks, and making sure we have the skills and that we have a culture that actually says, yeah, we're aware of risk and this is how we're going to go about it. I think the next slide is the last one from me to set the scene. This is from the International Institute for Management Development, IMD, and they talk about a holistic approach rather than just worrying about risk in individual silos, looking at cross-cutting themes and working out the best way to determine what the problem is, what the probability is, what a strategy might be, and how we have progressed in it. So if you're interested, you can have a look at those sources in those last 6 or so slides. Now we're into the next slide, which is Vincent sharing his more than 25 years insight with us. Out of these topics, we've decided that it will be of interest to the audience who are around the world to talk about, if we have time, hopefully, 3 of them: setting up a digital bank from scratch, the risk associated with that, the general topic of the appetite for risk, and then how people's perceptions of risk vary across Southeast Asia. I've mentioned that Vincent is in Malaysia, but has been involved in banking with a variety of organizations all across Southeast Asia, and how perceptions of risk vary by banking products. So, Vincent, welcome. Thanks for sparing your time. I should say at this point that Vincent is a graduate of our Chartered Banker MBA program, delivered by Bangor University and carrying a world exclusive award, the combination of an MBA, Chartered Banker MBA, and the Chartered Banker professional designation from our partner in Edinburgh, the Chartered Banker Institute, is globally unique, and we're very proud of that. And as you might expect, at the end of our chat, I'll ask Vincent a bit about how he found his studies when he was a student, and also we'll alert you to the programs we have and when the next editions run. So Vincent, what can you tell us about the approach that you adopted and your perceptions of risk in the digital bank from scratch? Previously, had you been involved principally in physical bank branching predominantly?
Yes. I think firstly, thank you, Professor Stephen, for the introduction. Very kind words from you. I think before I joined the digital bank setup back in 2022, I think primarily most of the prior years were, across the traditional banking setup. So that gives a quite good flavor perspective, as in, how do you organize yourselves when you are in a typical brick and mortar kind of business, as opposed to one where, when you start off a digital bank from scratch, it almost feels like it is a fintech startup. You have, the least people possible. And you still recall in my mind, when I first, had one of my preliminary conversation with my board risk chairman, right? My board risk chairman was saying that, Vincent, we will have to operate with a very lean capacity team. And, you are thinking that, from a typical bank in a brick and mortar fashion, you run in the hundreds of people helping you to man a complex risk organization to a point whereby you started off with like a couple of people as a core capacity team, and then how you think about setting a digital bank from scratch. And probably another information I would like to share is that, as I went through the journey, ironically, I also at the same time kind of enrolled in the Chartered Banker MBA, which was, I would think, I don't know if you call it a coincidence or perfect storm or whatnot, but you could imagine the days where you set up a bank from scratch, where you just have one empty piece of paper to, going through the MBA program. Certainly, I think that was pretty interesting. But I think nonetheless, having said that, one thing I find particularly useful was, it just got smacked on, when SVB crisis happened. In fact, that was one of the very preliminary topics in one of the board discussion earlier during the earlier days. I think the other part that really I think helped, when you have a lot of the new development is really how do you think about the situation that has unfolded. So of course, when you are the CRO, you've been asked about this topic, you almost literally have to quickly run and do research. I think one probably thankfully very helpful one was I happened to be doing the one of the topics called financial crisis and regulations. So when you talk about financial crisis and regulations, you talk about many of the crises that unfolds, the reason for that, which I think till today I find that it has been particularly useful. Even in the when I speak to our internal colleagues in terms of the ICAP stress testing work that we do, all this actually I find it to be particularly useful. I think the other thing is that as you think about setting up a digital bank from scratch, of course, we do have artifacts from the regulators, as in the digital banking, the licensing framework, in which you cover various topics and what you really need to do the setup. So I guess that really helps in a way. And as you think about it, it really span across corporate governance and compliance, risk management, the financial regulatory reporting. We talk about, of course, being digital bank, everything is really on technology, right? So technology and cyber resilience. How do we think about operationalizing products? And of course, I think last but not least, the most important elements of everything is really the people and the organization. Again, this is not a paid advertisement, but at the same time, when we were doing this setup, the other one that I kind of picked, which thankfully was also very useful, was on human resource and how we think about organizing ourselves. So these are some of the areas that we talk about when we set up a digital bank from scratch. And of course, I think Professor Stephen, I think in one of his earlier slides, talks about the various aspects of risk. You have credit risk, fraud risk, operational risk, model risk, market risk, technology risk. And when I look at the slides, I thought, oh wow, what a coincidence, because when we talk about setting the appetite for risk, in fact, these are all the principal risk types that we actually set our appetite. And of course, in doing so, you almost have to have a logical storyboarding to say why set this particular risk and the threshold, and what is the rationale for you in doing so. So we do have that set across. And of course, in doing so, we will need to demonstrate to the regulator our understanding and appreciation for risk and why. I guess, on the point of having a CRO, I guess it is not only about having a CRO, but often you find yourself in a position that you are being tested, on your understanding across various risk pillars. And of course, I think for many of us working professionals, right, when you go through a discipline, I think most of us would probably spend a long degree in a particular discipline. I myself, in my earlier career years, have been doing a lot more work in the area of credit risk, dealing with model risk, whatnot. But as a CRO, you cover really all across, right? Operational risk, market risk, and I guess what was kind of helpful was my earlier experience in the prior bank, where as the CRO of an Islamic entity, I got the opportunity, of course, look at various other risk pillars. So I guess that's how I would sum up, broadly my experience in setting up the little bank from scratch. I'm just wondering, Professor, if you have any question in mind that you probably want to ask on some of these topics. I'm happy to share a little bit more insights.
Okay, thanks for that, Vincent. And that gives me an opportunity to say to our audience that in order that we don't interrupt the flow of the conversation, if you would like to put into the chat area, you can see chat on the top strip. You can put in the chat area any questions, and then we come to the Q&A. I'll pick them out and post them and raise them with Vincent. So put your questions in the chat area for now, and if it's appropriate, we may ask you to unmute and speak, ask a question yourself. I think in terms of the explanation you've given about the starting up from scratch with very few human resources, and I think you described it as an empty piece of paper, one empty piece of paper. Yeah. So, of course, one of the things about entrepreneurs, and it is an entrepreneurial activity, setting up a new operation, is some people say, well, entrepreneurs take risk. I think I would clarify that and say entrepreneurs don't take unnecessary risk, or most entrepreneurs don't. They gauge the level of risk and take it from there. It was interesting that you referred to the studying at the same time on the Chartered Banker MBA, the financial crises and regulation. Sadly, there's always a financial crisis somewhere in the world, which is always good for organizations like universities trying to explain these ideas. You also talked about the CRO being trusted, and I think you referred there to your previous experience in private banking, which is about relationships, which is again about trust and things. And how do you demonstrate that you can be trusted? I've no doubt you can be trusted, but at the stage when you're starting up, you've got to speak to your shareholders, you've got to convince your fellow professionals that you're bringing on board, you've got to convince the regulator.
Yeah. On this topic, maybe I would probably kind of focus on. I think one key fact is that I think associated with setting up a new digital bank, of course, is that when I say an empty piece of paper, what essentially that also means is empty sheet of it is an empty balance sheet and P&L. So you could imagine on day one of operations, right? There are no income per se, and that tip. So we technically during the setup phase, we are technically burning cash, and of course, as shareholders, you expect your return on investments and for the bank to turn profitable. And the reason why I wanted to narrow down on this point is really because you will face certain pressure in terms of how do you accelerate and speed up revenue growth and profitability. And of course, there itself, there's discussion about then what products will you do? Do you take higher risk on day one? And you scale and accelerate the business. I think a couple of fundamental principle is necessary. First is that when it's an extremely lean organization, what really you need to think about is how do you build processes that can last over time and is resilient itself. So I think surely one thing is clear is that you cannot have a team that is made up of an army of team. So you have to think about how do you engineer your processes as such. Second is that how do you leverage on data and technology to your advantage? And coming to trust, I think in this aspect, when you speak about many of the topics, right? One thing that I suppose many people would really trust is really on data. So in terms of the approach principles of what we do in risk, many of the the principles that we set are data backed, and I guess that really helps. To me, I think that helps a lot. If you are talking about just briefly talking about risk topics, of course I could articulate in many fronts, but I guess one that was helpful, of course, is experience. Second is, of course, when you're able to back your facts with data. I think that one kind of helped a lot in terms of getting confidence and trust from the board and regulators.
Yes, and you referred when you were a couple of minutes ago discussing the setting up from scratch. You referred to a line item on one of my previous slides. But I think also what you've demonstrated in talking about you've got a very small team, you have to be trusted, you have to trust them, etc. are some of the things that it's talking about, the behavioral dimension and the need to build an organization around data, quality data, so you can back it up, as you've just said, but also investing in people with appropriate skills. But of course, I would say that because later on we'll be talking about come and get some of those skills, the CB MBA. But I think what you've just said, you talked about a minute ago, the level of risk you assume from day one. So perhaps we can move in from the digital bank from scratch. And of course, listeners can put questions in the chat area if they want to ask about that, or indeed any of the others. We've begun to talk about the appetite for risk, and the appetite for risk may well depend partly on who the stakeholder is. So regulators probably have quite a low appetite for risk in general, because they don't want their jurisdiction to be considered to be risky, unless they seek to attract criminal elements. And in our program MBA Financial Crime and Compliance, we do talk about there are some countries, some jurisdictions around the world whose regulators are relatively intentionally weak in their procedures, and they make money either for the country or for themselves selfishly through corrupt practices. But in general, one might imagine that the regulator in banking will have very high levels of risk aversion, and yet needs to still strike the appropriate balance to make sure that the financial system in that country doesn't fall behind what's happening elsewhere. Otherwise, the nation loses out. They're not seen as a financial hub anymore. I'd like to touch upon appetites for risk with customers. So you set your bank up, and then you offer product and things. How do you address the risk that customers perceive that you're a new operation? They may be good, I don't know. I think I'll stick with my existing operation. How do you overcome that problem of perceptions from the customer's point of view?
Well, I think when you set up a bank from scratch, as an unknown bank, right? Of course, I think then you would imagine, right? If I ask you to download an app, which is essentially a digital bank, right? You don't even get to speak to individuals. You don't have the branch network or people manning the counter that you could really speak to and bring an identity to. So the process that you build basically has to be one that is seamless enough and yet is secure. So much so that when customer goes through the process, first it gives you the convenience and also of course the level of security and the control that comes together with it. So customer really have to see through that process, and in doing so, basically one, of course, we use technology. We do have many of the state-of-the-art technology, but and how we kind of stitch it together is to make sure that the whole process of onboarding an account customer is seamless enough, but yet at the same time you have the sufficient safeguards in terms of protection and ID and controls over identity, and also surveillance necessary to also make sure that you onboard the right set of customers. To double down a little bit on that, what I mean is that when we kind of build our onboarding app, onboarding itself, if you think about a journey and you think about going through the branch, I'm quite sure many of us would have actually gone through the process of opening a saving account in a brick and mortar bank. And typically analogy that I always like to share with people is that you take a couple of depending where you are, you take quite some time to reach the branch, get a parking, get a counter, go to the counter, get a ticket, and then wait for your turn, get served, etc., etc. That can be as probably as depending if you happen to be the first customer, you could take less than 10 minutes. But of course, if you include traveling time, whatnot, probably could be more than that. And some people have the frustration of like going through half a day, 3 hours, 4 hours, and it does actually create that frustration. And sometimes you deal with inconsistent practices. The reality in a digital bank setup, customer wouldn't have that, the patience to wait for a few hours, let alone 10 minutes. So our onboarding process is probably less than, I think during the initial days, probably about 4 minutes, and is going down as we kind of improvise on our process here and there. And the security that comes with it also give you a sense that the whole process is secure. So we focus on the principle of what you have, who you are, and what you know. So basically, we do combination of technology to verify your identity. We do eKYC. We take facial recognition. We mix between the couple of different authentication process as you navigate through banking transactions. So I think those will provide customer experience, as in whether do they feel safe or not, and the perception to customers. Of course, then I would switch gear a little bit. And if you think about customers, there's always two sides. When we develop a process, we of course think about good customer and a positive flow, right? In reality, when you are moving so fast, what you also attract is scammers. And I think if you read news development globally, financial crime scam is probably an industry as big as banking. And therefore, in doing so, you probably have to have strong safeguard measure on fraud, AML matters. And I guess, there is always that line which is pretty blurred, whether is it a fraud risk or ML risk. And I guess to the point, I guess there's a question in the chat as well on the relationship with compliance. For us, that relationship was a very close one because when you come back with some of these matters, right? Our principle is it doesn't matter whether it's financial crime, AML, or fraud, right? I think traditional structure is as such that I take care of fraud, and therefore I define what is fraud, and that's the boundary that I'm going to serve to make sure I'm protecting against. And then you have other universe, which is financial crimes, ML, CFT, sanctions, whatnot, that comes under another one, right? Often, I think one of the questions I've been asked is that, hey, Vincent, how do you deal with mules? Mules actually sit smack on in between. So my response is often, it doesn't really matter whether it's fraud or mules. We will just deal with it. And when we have access to data, right, we will have to work together to make sure that we navigate through this process well. I hope I answered the question, Professor, and please feel free to clarify if you need further extension to my response.
Yeah, no, that's fine, Vincent. And of course, we could argue that all companies in all industry sectors need to KYC, know your customer, but it could be even more crucial, and bodies, national regulators and bodies like the Financial Action Task Force, supranational regulators, they're always very keen on stressing know your customer. And some people say, well, how can you know your customer if you are processing it and opening the account in let's say 10 minutes or less? And of course, one of the challenges for those banks who've been around for some time offering conventional branch banking face-to-face is how do they move into this? Because they're likely to have legacy technology systems that don't facilitate this rapid opening of accounts, etc. But the other issue about being totally dependent on technology, and it doesn't just apply to a digital bank, I don't think, is the risk that the system will collapse at some point, or that some malicious agent will get into the system, hack it, get records of customers, or hold the bank to ransom for payment, etc. And there's been lots of examples where banks, physical branch banks, have been offline for quite some time. The regulators have slapped them with fines, reputational damage. What can you do about, particularly seen as you're totally dependent on it in digital banking, what can you do about this risk of technological collapse or whatever?
Yeah, fortunately, unfortunately, is that the framework, at least in Southeast Asia, is pretty robust between the couple of jurisdictions, Malaysia, Singapore. I think regulators do first, they do speak to each other. And therefore, when we talk about the applicable regulatory framework, be it the RMIT framework in Malaysia versus the technology risk management framework in Singapore, I think the gist and essence of the framework are essentially pretty similar. I think one over the other, some provide more prescriptive regulation. And I think in those kinds of scenario, and I think going back to your question earlier, some of which, if it's actually regulatory mandated, it becomes an easier task for us, in the risk profession, because all I can say is that, in terms of critical downtime, 99.95% uptime is regulatory prescribed, and therefore, there's really no appetite for it. And I guess in this, in the regulation itself, right, it carves out really very specific in terms of the type of risk that we have to kind of manage. So of course, in terms of resilience, being a fully digital bank, you really have to be up most of the time, almost 100% of the time. So that is a critical downtime requirement that the regulation prescribe. And of course, we do look at, for example, security vulnerability between our applications, and the number of issues that we cannot go unfixed. We do have a number of these metrics that we actually do track on a monthly basis. And of course, I think they are also, there's always the threats of malware and other kind of bad actors in different forms. So we do have metrics dealing with it. Example, like for example, I think when you think of malware, you think about phishing links that usually these bad actors usually do, and we do have programs to test against this, and also to control the type of applications or movements that is actually happening. So we do have a security operation center that looks at activity running across the bank. I think these are some of the examples that I would probably give. I think probably 1 hour would be insufficient for me to go through all. But these are how we kind of storyboard and explain through the storyboard across different risk pillars, and then the necessary safeguards that we have to put in place.
Yeah, thanks for that. And you said in that response, you talked about the similarities between the regulatory approach in Malaysia and Singapore, and that moves us quite nicely onto this idea of perceptions of risk across Southeast Asia beyond Malaysia and Singapore. In the European Union of more than 20 nations in Europe, the European Union Anti-Money Laundering Agency has just been established, and that will or seeks to establish the same regulatory framework across all members of the European Union. And that, in theory, is claimed that it will mean that there won't be arbitrage where people who have suspicious or fraudulent intent go for the country that has the least or the weakest regulation and things. Is there any sign yet that across Southeast Asia there's going to be a common set of regulatory standards?
I think at the very least, across the many Southeast Asia kind of markets that have been through, be it Indonesia when we deal with OJK, or Bank of Thailand, or even in Philippines, I think like what I say, the regulators across Southeast Asia, I think especially the countries I've mentioned, are pretty much connected. You would imagine that just a couple of years back, we all remember COVID, and those were a tough period where there are a lot of measures that the across jurisdiction we have to kind of provide for. And I think back then I happened to manage risks across 7 Southeast Asia countries, and when we talk about regulatory measures, right? When COVID happened, the time that takes, we almost have to work, over time to really make sure that reform measures are promptly rolled out, because people are all locked up at home, right? So one thing that when I reflect back, during those times, the measures that we put in, the lobbying that we have, to regulators, it wasn't extremely difficult. And you could imagine that back then, moratorium and basically repayment assistance program was pretty common. And when we do that across, we did have playbook that runs across countries. And when we do a comparison of all these measures, right, and then the same regulatory prescription that was actually provided by the regulators, pretty much it almost feels like it moved in tandem. But of course, I would say that depending on areas, there could be differences, and one would probably learn from the other. But I guess if you are thinking about, for example, how about a digital licensing framework, I guess if you do some research, you will see which are the jurisdiction that has already have digital banking set up and this framework in place, which has not, and then you could probably gauge the differences there. But nowadays, I think it's not too difficult for those markets who probably want to evaluate. So I think they'll be just a call away from their neighboring regulator to get feedback and whatnot.
Yes, and of course, what we've been talking about here is we've been talking about those people who operate in the legitimate financial services arena, and there will always be organized criminal gangs who take advantage using technology to move money around, to launder it, etc., including those who use it to finance terrorist activity. I'm going to start drawing things to a close so we can have some questions. But just before we do that, we've talked about Southeast Asia. And when we talked about the customers, of course, risk, if the customers can't overcome their inherent risk, then whether you're a bank branch network or a digital bank, that's a challenge. Many people are concerned about, I'd rather see my cash with a fixed interest rate, although I know it won't grow very high. I don't yet trust. I feel it's risky to put money into stocks and shares. And of course, in the last couple of weeks, stocks have been, well, mainly trending downwards and occasionally trending up, but haven't bounced back to where they are. So risk has a wide variety of aspects, from the provider's perception of risk, the regulator's perception of risk, the customer's perception of risk, risk management, as it said in the very beginning, before Vincent started sharing his insights, as risk is something that affects us all to a greater or lesser extent. I'm going to have a look in the chat area. So this is the time when please start putting your questions in. So, okay. Weedy talks about compliance and regulation, the relationship with the compliance elements. What can you say, Vincent, there about compliance? Because although the Silicon Valley report in the Wall Street Journal said it's the most thankless job risk assessment, it's often said so is compliance. The compliance officers in a bank are trying to keep the bank's name out of the headlines, keep it from being fined, and also at the same time helping the bank go for growth, which generates profit.
Yeah. I think one thing that was I find particularly helpful is that I think thankfully in this part of the world, there's probably one policy that was particularly useful, and that's basically saying that CRO has the right to of unlimited should not have unrestricted access to the board, and it has to be independently appointed. And I think the importance of that is basically to ensure that when the governance or control function sees issues, right, they have the access to the board to voice these issues, and I think it further cut deeper to say that even if you have your CRO leaving the job, a full investigation has to be carried out, and that basically demonstrate the stance that the regulator takes on the importance of the role of a CRO. I guess that kind of help ensure that when we see issues, we do have that right to voice out. And of course, I think also the remuneration for control functions are kept independent, meaning to say, at least I think in Malaysia, the regulator makes it very clear that the CRO cannot hold growth matrices, and I think rightly so, so that the decision is actually not influenced purely based on growth and greed.
Yeah, I mean, I think that's a very important behavioral thing in some parts of the world, which kind of leads into the question that Patrick has put there. But in some parts of the world, there are, shall we say, politically connected individuals who are not employed in banks, and some regulatory regimes in some parts of the world don't pay much attention to the influence that they may have in setting bank strategies, etc. I think, Vincent, you've worked for Standard Chartered before, HSBC, was it?
Standard Chartered and Citibank.
Yeah, okay, so they're very big global banks. And Patrick asks the question, perhaps it's from where he's operating himself, how risk is perceived in financial institutions outside Asia, for example, in Africa, so that perhaps I wonder whether in Standard Chartered, all these big multinational banks have branches in many countries. Did you ever encounter any different approaches to perceptions of risk within the financial institution itself?
I think the broader financial institutions essentially had matrices that run consistently across the globe. We do have global policies that cut across. So really, if ever I were to go to any different countries, we talk about the global policies. Everyone could understand what Section 5 is about, what section is about. So there's a lot of consistency there. As in how risk is perceived in financial FIs, I suppose one easy way is really if you dig deep enough on risk matrices, and depending on the level of disclosure, I guess it's pretty easy. The moment you look at the published financials, the Pillar 3 disclosures, I think that take a deeper read and you will probably have a sense what are the similarities and difference. And I guess that's where a lot of analysts do analyze, between different banks. I think that's something that we used to do a lot when we were managing crises in other countries. We do look at which bank are more resilient, and that's what exactly we look out for.
Thanks for that. And kind of following on from Patrick's question, there's one from Moketsi, who says, how can you audit the risk where there's insufficient regulation and policies? And he again gives the example of Africa, a gap in regulation, and those responsible usually defend their positions with law, whilst the auditor's relying on best practice. Well, I referred, before I asked Vincent his view, I referred a little while ago to the guidelines, the recommendations of the Financial Action Task Force. And of course, that is the body, and increasingly the European Union Anti-Money Laundering Agency will regularly review countries and may put them on the grey list, may put them on the blacklist. Getting off the blacklist is very challenging, and we have to presume that perhaps those countries don't particularly want to get off the blacklist. But the grey list has impact on how your banks can trade in the global ecosystem, and also how some of your industries can trade. The challenge of insufficient regulation also comes down to the nature of the political system in a particular country and those politically connected individuals who set regulations or set weak regulations. Or any thoughts on this problem of insufficient regulation? The examples you've given of Singapore and Malaysia are very strong, long-established regulatory frameworks that buy into global international standards. I don't know that there's much, unless you've got a view, Vincent, that institutions will do. Some institutions will prefer to go to a place where there's weak regulatory practices.
Yeah, I mean, I guess that's the lens I would put is really, regulation aside. I guess, of course, regulation is there, and when you have certain measures being prescribed, that probably makes your life easier. But I would imagine myself if I ever one day were to be posted to a different regime, right, and where it's least regulated, I guess the principles of policies is, I think, the gist which is important, and it is important to get that, because ultimately, what are all the regulations meant to prevent? It is really to prevent issues of excessive risk or of the bank failing, right? So I guess fundamentally, if you were to ask me today, would I really need to rely on the regulatory framework, say, for example, to set credit risk metrics, right? I would almost say that I don't necessarily need to rely on the regulation. But of course, if we need to anchor on some, perhaps, I guess, to what Professor Stephen has mentioned, you could always make reference to some of the best practices in the industry. But of course, having said that, I would also appreciate the fact that often than not, if you operate under a regime where there's no such regulatory policies in place, the risk, the role of a risk professional may become a little bit more difficult, right? Because you may be challenged to say, if there's no such policy, why are you putting forth such measures? And then that's where probably, I guess, one of my closing remarks is that it's also important for us to understand the kind of culture in a particular organization. I think risk works best in an organization whereby there's appreciation for risk and it's an independent function, not necessarily is regulatory dependent.
Yes, I think that's right. And just as we draw close, one thing I should say is Vincent has kindly said that if you still have any questions when you reflect on it, or if you're somebody who listens to the recording, do pop them to us and we'll forward them on to him. But what we've been talking about there about regulations is, I think it's an important point that is just made, that says don't just rely on the regulator, because you may be tempted to go for a weak regulator, and then when you try and move elsewhere to a different part of the world who has a stronger regulator, you're in trouble. So you don't chase to the lowest common denominator. You have your own view of what it is, and the more robust it can be, the more regulators it will satisfy around the world. Just to finish off with one example that comes from our MBA Financial Crime and Compliance, and then say a little bit about our programs. I talk about in my module in the Financial Crime and Compliance about the UK Financial Conduct Authority, a regulator. And you might imagine that in a global financial centre like the UK, they would have everything fully organised and under control. Unfortunately, in the last couple of years, they have been investigated by parliamentarians in the UK system and been found to have, although they're setting the regulations and expecting that banks will comply with it, and they're monitoring the behaviour of banks, etc., they themselves, the regulator, have been found not to have a culture that encourages their employees in the regulator to whistleblow, for want of a better phrase, when they find poor practice and things. So Yeah, there's always the possibility for weak regulatory or poor regulatory practice, even in countries that might be considered to be part of the or key parts of the global financial ecosystem. So as I've just said, if you have further questions, please do direct them via us to, and we can pass them on to Vincent. Thank you so much, Vincent. I'm just going to now move on to the next slide that says, if you could, those are the programs we have. Any short words? You did the Chartered Banker MBA. Any short insights to your experience? Was it useful? Was it too demanding of time? What might you say?
Yeah, when I took the Chartered Banker MBA, of course, one is probably a higher accreditation, and also one thing that I was actually keen to do is to kind of I think test and also reverse test and apply firstly to gauge what I've gathered over the last 20 years or so, and reflecting experience to what is actually taught in the course. But also I think on the reverse is really applying it to then the work itself, and I find that it was particularly helpful. If you think of it as just another course, probably then it will serve very little. But to be honest, I would really I'm quite proud to say that many of the topics I've actually learned, I do apply seriously enough, to various aspects. And just last week, when I was speaking to my auditor, I was making reference to one of my research work during the financial crisis and regulation, part of the subject for Chartered Banker MBA, that talks about the comparison of the crisis, the Asian financial crisis to the global financial crisis and whatnot. And there's a lot of good discovery there that I really do not need to look at a textbook whatnot, which I find extremely useful. And this is something that the late Professor Ian Hardcastle, he often emphasized that he would like to see how we relate this into real world. And I would encourage everyone of the folks here taking these courses to do so. I think you'll find that it will be very useful.
Well, thank you so much for that ringing endorsement. I have to say we didn't practice that in advance to everybody who may be listening. There's a genuine recommendation. He used it when he was studying, and he still continues to use it. So that's great. So on the screen, we've got Chartered Banker MBA, the one that Vincent did. A Financial Crime and Compliance MBA, which has a different partner, but equally is a globally unique program. Chartered Banker MBA is the only MBA awarding the Chartered Banker status in the world. The Financial Crime and Compliance is not to teach you to be a criminal. It's to teach you how to find it and stop it and be compliant with regulations around the world. We have an Illicit Finance MBA, which is a subset of financial crime, which is about national security and aspects. And the important thing to show or share with you at the bottom of this slide is single modules. You don't have to commit to take the whole program. If you're busy, as indeed Vincent and all our students are, then you might prefer just to try one module just to see if it fits in with your way of learning and the amount of time that you can devote when you're balancing work, family, social responsibilities and study. So single modules are available to give you a taste, and if you complete the assessments for that, then you gain credits that you could then trade in should you come back for the full MBA, a postgraduate diploma or a postgraduate certificate. If you'd like more information, the final slide tells you how to get it. The final slide says, there we are, get in touch. It's flexible, it's online. It's been going for 15 more years, and we've graduated more than 1,200 students around the world. And it's designed, as it says, to fit in with the life of busy professionals. It's a dual award, and it's unique. It is globally unique around the world. So to find out further information, including about our April 2026 intake, please do get in touch in the website there. It remains only for me to thank you, Vincent, for coming and sharing your insights, not only your endorsement of how you learn things on the program and still apply them, but also different aspects of risk. Risk is something that we all face in our personal life, in our working life, and we've had a great insight there. And there'll always be more we could talk about. My final comment is probably, as one of the references said, and please, those who are listening, please do have a look at those, the sources for those references. We need a holistic view. We can't have silos where different people are thinking about risk in different ways. We need a across the organization, a holistic view.
I think
Thank you very much, Vincent. Next time I'm out there, we'll have to meet for a coffee.
We sure will. Thank you, Professor.
Thank you. Cheers, Vincent. Bye-bye, everybody. Bye-bye, Vincent. Thank you.